Okay, so after we have prepared the manufacturing overhead budget, now it's time to prepare the operating expenses budget. So here's where we're going to budget all of our period costs. So research and development, design, marketing, distribution, customer service are all part of the operating expense budget. And again, we will have the variable piece and the fixed piece. And so the variable period costs will be based on the number of cases sold. So we'll pull these amounts from the sales budget, and you can see example: sales commission, shipping, bad debt expense. Okay, these are all an amount per unit sold. And then we've got our fixed operating expenses: salaries, office, rent, depreciation, advertising, telephone, etc. Okay. After we have our operating expenses, then we can prepare our budgeted income statement. And so we need to get our budgeted manufacturing cost per unit. We take our direct materials budget and we can get the amount of direct materials per finished good, multiply that by the cost per unit of direct materials. The direct labor, we take the number of hours, the time it takes to make one unit, times the hourly rate. The manufacturing overhead budget, we take the variable overhead per unit, and then we can get the fixed overhead per unit by taking the total fixed manufacturing overhead and dividing that by the budgeted units. So here's an example of getting our budgeted manufacturing costs. Direct materials, which was the number of pounds per unit times the amount per pound. Here's the hours times the hourly rate. Here's the variable overhead per unit. And then we took the fixed and we divided it by the production. Okay. So then we got the cost. So our sales revenue we get from the sales budget. The cost of goods sold we get by taking the budgeted units sold from the sales budget, multiply that by the budgeted manufacturing cost per unit. That's where we get our gross profit. Our operating expenses come from the operating expense budget. We get our operating income. Apply our tax rate to get income taxes expense, and then we get to net income. So in the example that we were working on, we need to get, well, our sales revenue we can take right off of our, let me just see. So our December sales revenue was $7,500, or $7,500,000. Our cost of goods sold, we would take by multiplying the $125,000 by the cost to make one unit. Well, we can see we need 1.5 pounds to make one unit, and each unit costs $4.50. So if we look at our direct material cost per unit, so the 1.5 pounds times $4.50 comes to $6.75 per unit. For our direct labor, it takes 2 hours to make one unit, and it costs $13.50 an hour. So our direct labor is going to be $27 per unit. Our manufacturing overhead, we need to get our variable piece, and we get that if we look on our manufacturing overhead budget. It's the $2 per unit plus the $1.10, so that's $3.10, plus 60, so it's $3.70 in variable costs per unit. So it'll be $3.70 for the variable overhead, and then the fixed overhead we'll get by taking the total fixed overhead from the budget. So our total fixed cost is $33,350, and we're going to divide that by the 123,500 units. That's going to give us our fixed overhead per unit. I'm going to reduce the decimal places. I did it again. One more time. All right, so the total cost per unit is going to be the sum of all the manufacturing overhead costs. $37.72 per unit. So our cost of goods sold is going to be the $37.72 per unit times the units sold of 125,000. Let me get rid of the decimal places. So that's how we'll get our gross profit, by subtracting. And we didn't do an example of the operating expense budget, but that's where you would get your operating expenses. You'd pull that right off of the bottom line on the operating expense budget. So that's how you do the budgeted income statement. Oops. After you complete the budgeted income statement, then it's time to move on to the financial budget components. Okay, so our capital expenditure budget is where we're going to show what the company is going to spend to buy new property, plant, or equipment. These are our capital investments. Okay, and so you can see they'll plan out. This company wants computers, delivery vans, production equipment, and then you'll decide what month you're going to go and make these purchases. That's all the capital expenditure budget is. The next one is the cash collections budget. We need to project when cash will be coming in. Now, it depends on how you structure the terms of credit. COD sales, those are your cash sales. You expect them to pay cash. You're not giving them until the end of the month or whatever, 45 or 60 days to pay the invoice. Okay, and so companies may have a certain percentage of their sales that's typically cash sales, and then another percentage that's typically credit sales. If you are doing my group budgeting project, all of the sales are going to be credit sales. Okay. But for this example here, I'm going to show you both. So here, some of their sales were cash. That means they collected them in the current month. Okay. And then the rest were the credit sales, and they said 85% of the credit sales are collected in the month following the month of sale, and then 14% are collected 2 months after the month of sale. 1% is estimated to be bad debts. Let's take a look at an example of a cash collections budget. Okay, so in this one they say they estimate 40% of the sales are the cash sales. The remainder would be credit. So we're saying 40%. So here's our cash sales for December, January, and February. The rest of the sales then, the other 60%, are credit sales. And so we're trying to figure out how much cash we'll be taking in January and February. They say clients usually pay 20% of their account in the month that the service is provided, 80% in the month following the sale. So in January and February, we'll be getting all of the cash sales. Right? So 110 is the cash sales in January. 215 is the cash sales in February. And then we got to figure out when will the credit sales come in. So we're saying 20% is received in the current month, and then the other 80% is being received in the next month. So in January, we will be collecting 20% of the January's sales. $22,092. Actually, that's not the right number. I took 20% of the cash sales. It should be 20% of the credit sales of January is being received this month. And then we'll receive 80% in the next month. So in January, we'll be receiving 80%. Actually, this should say the previous month. Right? Because in December, we would have collected 20% of the December credit sales, and then the other 80% comes in January. So in January, we will be collecting 80% of December's credit sales. Okay. So the total cash collections in January is the cash sales for January, 20% of the January's credit sales, and 80% of December's credit sales. So we will be receiving cash of $230,000 in January. In February, we'll be getting 20% of February's credit sales. And then we'll also be getting 80% of January's credit sales. So we'll be collecting in February $412,275. And so this is going to be important when we're trying to do our cash planning. We know what cash is coming in. We also need to determine what cash we need to pay. Okay? So for instance, the tricky part is usually direct materials. Those are usually bought on account, right? So we'll pay for some of them this month. Some of them we may pay next month. Some of them maybe we even pay the month after that. We have to schedule out when we will be paying those direct materials. So we will refer back to the direct materials budget and to see what we're buying, and typically those are going to be bought on account. Direct labor, typically paid in the month incurred. Manufacturing overhead is typically paid in the month incurred, except we could be including some non-cash items. So depreciation is a non-cash expense. So it's going to be an expense that we take on our manufacturing overhead budget, and actually same on the operating expense budget, but those don't involve a payment of cash. So when we look at the manufacturing overhead total amount, we need to subtract out the depreciation. Okay. Same for on your operating expense budget. Depreciation and actually bad debt expense also. These are non-cash expenses. They don't involve a payment of cash. So when we're doing our cash payments budget, we'll take the total from the operating expense budget and we'll subtract the depreciation amount, we'll subtract the bad debt expense amount. We will go to the capital expenditures budget and see if there's any property, plant, and equipment that we're buying in that period. And then we'll add that to the cash payments budget.